Good afternoon, everyone. Thank you for joining Prequin's Q3 2018 quarterly update. We will be now commencing the webinar. My name is Carmen, and I'm based in Singapore, leading and supporting Prequin's marketing activities for the APAC region. Here with me today is Fai, Prequin's Head of Asian Operations, and he will be discussing various market trends that have been observed in the last quarter. Before we begin, should you have any questions during the session, feel free to drop them to us through the webinar console via the questions or chat functions, and we will try our best to get to the questions. Otherwise, feel free to reach out to Fai or our Prequin events team separately.
Thanks very much, Carmen. Hello, everybody. Very warm welcome to our webinar here in APAC. I head up our Asia operations in Singapore and Hong Kong, but most of my work actually revolves around the research team. A very quick update on Prequin before we dive into the data. We're headquartered in London, but we've been operating in Asia for almost a decade now. And with more than 500 people worldwide, we provide our clients with the best-in-class data for private equity, venture cap, real estate, hedge funds, and other asset classes under the alternatives umbrella. And we have actually invested a lot in Asia. Our team of 180 staff speak more than 8 different local languages, including Chinese, Japanese, Korean, and Hindi. And this allows us to have the widest coverage possible of any research firm. Our clients include pension funds looking to do due diligence on an asset class before investing for the first time, experienced managers looking to benchmark themselves against their peers, managers monitoring their portfolio, and even university professors teaching a finance class. So what can you expect in this webinar? Well, all that has happened in Q3 in the alternative sphere globally on fundraising, investor appetite, performance, as well as deals information. We'll show you which strategies have garnered the attention of the market, which ones are struggling, the top performing asset class, as well as the comeback kits. We'll not be able to go through every asset class in detail, of course, but I'll do what I can to highlight the really key stuff that you need to know as we head into 2019. So first up is fundraising, and fundraising is important because it reflects current investor appetite, and it's always useful to know what the market is thinking. So as of September, $187 billion has been raised by private capital funds worldwide, and this includes PE, VC, real estate, infra, natural resources, as well as private credit. Fundraising has been strong this year, but it looks unlikely that we'll see top the record-breaking growth we saw last year. And with Q4 usually seeing a flurry of activities, we expect the overall fundraising in 2018 to match the really strong years of 2015 and 2016. And here on this chart, we can see that the number of funds raised this year is lower compared to the past, and this shows that average fund size is on the rise. Strong performance and track record have pushed re-ups such that experienced managers are now increasingly able to raise successive larger funds. Well, the darling of private capital right now has got to be private credit funds. Fundraising is already ahead of the 2017 total at this point last year and is very much on track to another stellar year. Within this space, direct lending continues to lead in Q3, which has been the trend for many years since the reformation of banks after the global financial crisis. Now, if we dive into direct lending, you can see here that North America makes up the larger proportion of global capital. North America is the dark blue bar across the entire chart, and this is especially apparent in 2011. This year, interest in Europe has actually shot up until Q3. Europe was actually ahead in terms of aggregate capital raised, and it was only in Q3 that North America pulled slightly ahead, owing to a couple of billion-dollar funds that closed. But as you can see here, both regions are now head-to-head. So we are seeing optimism for further growth in Europe, where traditional lenders face constraints on their balance sheets. We see retrenchment still ongoing, and there's also a general weakness in these lenders' ability to lend. Turning our attention to another bright spot in alternatives, we see almost $75 billion raised by real asset funds in Q3, which is the best quarter in the last 2 years. So we defined real assets as infrastructure and natural resources. What's more amazing is that capital raised in Q3 represented about half of the year's total tally. And this table shows the 5 largest real assets funds to have closed in Q3, of which the top 3 were each $7 billion or more. What's also interesting here on this slide is that these are managers raising their second, third, or even 7th fund in the same series, indicating that their strategies are successful and how such a stellar track record is still the surest way to raise capital. Now, if we look ahead to the rest of this year and 2019, we see a record number of private capital funds in market right now, and about half of that by total cap targeted lies in private equity, which includes venture cap, while the remainder is more or less evenly split across private debt, real estate, as well as real assets. And as much as private equity is the attention grabber here, with about 4,000 funds vying for just under $1 trillion in capital, what caught our eye was actually infrastructure. Now, we've seen the infrastructure sector grow in the last few years, and funds which closed in the first 3 quarters of this year achieve an average of 120% of their target size. So these funds are closing much larger than what they set out to do. These funds have experienced an unprecedented level of investor commitments, and this is apparent in this chart showing funds in market over time. I'd like us to focus on the 4 rightmost bars, which are the number of funds out in the market at the start of each quarter this year. And this number has risen gradually since Q1, while the aggregate capital targeted is up $20 billion compared with the start of Q3. Almost half of these funds are focused on Europe, while North America and the rest of the world each make up 25%. Moving on to hedge funds, the ongoing public market volatility has actually led to a 5-year high in the number of new fund launches. In particular, new funds deploying equity strategies have jumped to 47% in Q3. And these are managers who see an opportunity to take advantage of short selling and pricing differentials in short-term trades. We did a survey of international institutional investors in July, and 28% of them said that they believe APAC holds the best opportunities for the next 12 months. And as a result, funds focused on the Far East have seen a surge in launch activity in the last quarter. Managers are backing the region to provide opportunities in the future, with 18% of launches in Q3 pursuing an APAC focus. Now that I've touched on the state of the fundraising market, let us now take a look at performance as well as dry powder of alternatives. Right, so this is really a fascinating look at 18 years worth of returns data of private capital and how it compares with the public market. And our proxy for the public market is the S&P 500. As you can see, private capital as a whole has outperformed S&P by about 150 basis points, and we expect this trend to continue. And what's interesting here is the gray line at the top, which is distressed private equity, and that has outperformed all other asset classes in this graph in the last 10 years, and that's a fantastic achievement. The rise of private debt started from the time after the GFC, where there was a rich picking of deals at depressed valuation. In the era of cheap interest rates that characterized the period after, managers of distressed assets were able to further leverage their investments and turn loss-making companies into profitable ones. Now, the other aspect to performance is cash flow. And cash flow includes, excuse me, how much capital is called, how much distributed, and the net of both items. What we're seeing here is that in the early days of private equity as an industry, capital call mostly outweighed distributions. Things started to change in 2011 when cash flow went positive for the first time and has remained positive and grown in the 5 years after that. In 2017, distributions normalized a bit, and we see that reflected as a downward growth in the net cash flow. That's a green line. Now, we've seen a spike in dry powder in recent years for real estate, which is also evident across the rest of private capital. Could this be a cause for concern? Well, high dry powder represents a selection pressure on managers as deal making becomes more and more competitive. If we add that to the fact that interest rates are already starting to normalize, we can see that there are some serious headwinds for real estate managers. However, we all know that pricing isn't the only part of the deal's equation. Just as important is the ability to navigate regulations, make use of efficient taxation, as well as local knowledge of the investment destination. So actually, increased competition allows managers to shine in these aspects. And tougher conditions are also an opportunity for investors to tighten on manager screening as well as due diligence. If it's any consolation, hedge fund managers are not having it any easier. So we can see that hedge funds have, on the whole, underperformed the S&P 500 for almost every quarter of this year. And if we stack that against a 2, 3, and even 5-year annualized view, things still don't look too good for hedge funds. And there are some strategies which can and have outperformed the market owing to their ability to take advantage of this increase in market volatility. And we think that these are the ones which will attract investor interest going into 2019. Now, coming back to private capital and diving into VC, VC deal activity is at its strongest now. Q2 was the first time ever that more than $70 billion worth of VC deals were made in a quarter. In Q3, we saw about 1,500 VC financings take place in North America, which is the highest number since 2015. And this represents slightly less than half of the global total. APAC represents the next big chunk of the VC pie, with most of it coming from China and India. IT and fintech continue to be the most attractive sectors to invest in, especially as barriers to entry are low, and there's a tendency for regulations and taxation to play catch up. On the other side of the private equity spectrum, buyout deal flow remains strong. We see here that the number of deals completed, so these are the dark blue bars, is steady at 1,200 for each quarter since October last year. The largest deal that was done this year was the $21 billion M&A of Keurig Coffee and Dr. Pepper at the start of the year, and there were 3 other deals that topped $10 billion. And going forward, we do expect this sort of mega deals, this trend of mega-sized deals to continue as the industry chips away at the dry powder overhang. Similarly, on infrastructure, deal value is higher in recent quarters compared to 2013 and 2014. The 24% decrease in the number of deals compared with Q2 reflects the ongoing challenge of sourcing attractive infrastructure assets. And we're seeing most of these deals continuing to be done in North America and Europe, which has actually seen a 6 percentage point rise from Q3 last year. Australia and New Zealand make up the smaller share of global deals, but they have the highest average deal size at $1 billion of any region, reflecting how advanced this market is, and the recent large-scale privatization of public assets. And those of you on this call who are familiar with the market will know that Aussie supers have a natural affinity for infrastructure. 1 out of every 3 supers have at least a 5% allocation, while just 1 in 5 global pensions have the same allocation. And here in Prequin, we are very close to launching a comprehensive report on how supers invest in alternatives. If you are keen to get a copy, please feel free to let me know via email. So we've talked about fundraising, performance, dry powder, and deals. Let's now take a look at asset allocators and their outlook in the next 12 months. Investor sentiments continue to be strong, and these numbers are from our second half 2018 Investor Outlook survey. In almost all asset classes, a greater proportion of investors expect to invest more in the next 12 months than those who are going to invest less. Of particular importance are infrastructure and private debt. These are the 2 asset classes which are attracting a lot of investor attention. And what's driving this is a desire for yield and returns. In a world where public market pricings are becoming more efficient, we are also seeing investors turning to emerging markets in Asia in their search for market inefficiencies as well as diversify their portfolios. One continuing theme in APAC is that investors tend to go with established international names when they are investing for the first time, but almost everyone we spoke to said that they would seek out local boutique managers once they've gotten a few years of investing experience under their belt. investors are looking to invest less in natural resources in the next 12 months, and that is also reflected in the next chart on the number of mandates issued in Q3. Now, however, there are themes within natural resources which are interesting for investors. I was actually in an agriculture investment conference in Tokyo recently, and agri-tech was one of the fascinating topics that was discussed. Farmers are now using drones to monitor their crops and livestock. They are using efficient delivery systems for water and nutrients instead of traditional irrigation. And there are smart greenhouses where farmers can tweak 100 different settings to create the most optimal growing conditions. These are all areas where technology has disrupted traditional farming. In addition, vertical integration allows fruits and vegetables producers to can and to juice their unsellable product to reduce wastage and to boost their margins. Again, this follows the same theme of investors seeking inefficiencies and opportunities in the market. Comparatively, investors are more positive on real estate. About a quarter we spoke to said they were going to invest more in the next 12 months. And all strategies are on the table, as you can see by the much longer light blue charts for every strategy. The increased interest in distressed properties seems to be most pronounced, and that's possibly helped by the fact that interest rates are rising faster than income growth. Not only are investors showing greater attraction for real estate, but they are also planning to place increasing amounts of capital in the next 12 months. We can see 57% are looking to commit at least $100 million to the asset class, compared to just 39% in Q3 of last year. So this is a stat that's not on this graph. So, in summary, appetite for private capital remains strong. There are some weaknesses in hedge funds owing to the volatility in the market, which are caused by geopolitical as well as macroeconomic events. Returns continue to be very good for investors in alternatives, and looking ahead, investors are planning to invest more, not less. And I should also add that in the medium term, appetite looks good too. In our recently published Future of Alternatives report, we forecasted an AUM of $14 trillion for the entire industry in the next 5 years, compared to where we are now at $8.8 trillion. So I've come to the end of my deck, and wanted to thank everybody for your attention and for staying with us till this point. I would like to ask if you have any questions, please type it in the questions box. It should be in the GoToWebinar console, and we will collate the responses and we'll answer it now.
We'll now take a few minutes to collect any questions from the attendees. Okay, so we have one over here. So Fai, are there any hedge fund investors reaching for the door?
Well, I think we saw in the slides that hedge funds hasn't outperformed the S&P in the whole of this year. And our data shows that the outlook for hedge funds is definitely less rosy than this point a year ago. 2017 was what we in Prequeen call the perfect 12, where hedge fund returns were positive in every single month of the year. Well, the thing is, there's just more unpredictability in the market these days compared to before. People were wrong-footed on the US-China trade war. Most thought it wouldn't start, and when it started, people thought it would be over quickly. And at this moment, it's still dragging on. And Europe is dealing with a looming Brexit deadline. There's a bit of disunity within the bloc. There's changes in several governments. But there are bright spots though. Our data shows that equity strategies like long bias and long short make up about half the top 20 performing or the 20 top performing funds this year. So while swings in the market have definitely helped managers of these strategies to deliver outsized returns to their investors. So I'm not sure they're reaching for the door just yet.
Okay, so we have another question from someone who's establishing a new PE venture fund to be invested in European biotech, tech, renewables, mid-market companies. So which investor base should I be targeting in my first 12 months of capital raising, and which jurisdiction?
Okay, so thanks, Ravia, for that question. It's a very interesting one. One of the ways to do this would really be to go onto our database, where you can do an advanced search and look at which investors would be possibly interested in your strategy, and to sieve out those that have previously committed to the similar strategy. But off the top of my head, I just had a very interesting conversation earlier this week where I was talking to one of the most active VC managers in the world. So they were saying that they were looking to fundraise next year, and some of the investors that they are targeting would be family offices. So we've all seen a rise in family offices in Asia. Some of these are actually wealthy families from Europe as well as the US, coming down to Singapore and Hong Kong to set up a local office to run the investments here, looking at APAC. We also see a growth and a rise in Asia family offices. So these would be wealthy individuals as well as their corporations in China, India, and within Southeast Asia, the Indonesian, Malaysian family offices are also pretty strong. So that would be my very short take on some of the investors which you can target. I hope that answers your question. If you want a bit more information on which investors really have invested in your strategy before, please feel free to connect with me after this call, and I can show you what we have on our platform.
So we've got one more question coming in for EFI. Do you see there being a trend of further expansion and thereby growing concern in compliance issues for onboarding of prospective investors globally?
Yeah, thanks, Christopher, for your question. And these compliance issues you mentioned here could be in terms of AML, CRS, as well as FATCA. Well, definitely, when I do recall when FATCA first came out, everybody didn't know what to do, and there was a general sense that the market will sort itself out. I will wait to to see what the bigger investors or the bigger fund managers are doing before I start looking into this myself. And I do get a sense that from my conversations with the industry here in Asia, we are taking these sort of regulations more seriously. Compliance has traditionally not been a strong suit for Asian institutions, and we're starting to see this change now. And that's because the portfolios of Asian investors as well as fund managers are becoming more and more international. So we have spoken to managers, and they have said that compliance costs has increased, and they are now starting to staff their teams more professionally. They are hiring in-house counsels. They are going out there to look for consultants who can help them with these compliance issues. Even for ourselves in Prequin, when the Data Protection Act in the UK first came up, we really had to seek legal advice, and what we did was also to speak with other research firms in the space to see what they were doing to comply with these new regulations. And because of all these conversations that took place, we managed to craft up a strategy that will help us to navigate the Data Protection Act going forward. Okay, any other questions? All right, it looks like I did a pretty good job. No, I'm just kidding. Well, if any questions come up later, please feel free to drop me a note. Just quickly show my email address again. Yes. So do drop us a note at this email address, and we'll be happy to connect with you offline.
We have come to the end of our webinar. So a recording of this webinar and slides will be made available for those who have joined us, and also for those who are unable to make it today. Coming up next, we have the Q3 quarterly updates for EMEA region on the 15th of November at 10 a.m. GMT if you're interested. We also have a series of Future of Alternatives webinar arranged in Q4. So we hope you'll be there at our next webinar. And this is Carmen and Fai signing off. Have a good afternoon ahead. Thank you, everyone.
Thank you for joining us. Bye now.